ever wondered what happens when you need funds and your only asset is a life insurance policy? This is where policy loans and withdrawals come into play. Policy loans are quite simply loans that you can borrow against the cash value of a permanent life insurance policy. Think of it as a financial safety net, an extra cushion that you can fall back on when you need it the most. On the other hand, we have withdrawals. These are amounts that you can take out directly from the cash value of your policy. However, it's important to remember that withdrawals reduce the death benefit of your policy. That's the payout your beneficiaries will receive upon your passing. Both policy loans and withdrawals provide a way to tap into your life insurance policy without surrendering it. So policy loans and withdrawals can be a lifeline in times of need, but how do they work? When it comes to policy loans, think of your insurance policy as a personal bank. It's a unique concept, isn't it? Unlike traditional loans, policy loans don't require credit checks or have rigid repayment schedules. Here's the catch. The interest that accrues on your loan isn't just some phantom number. It's added to the loan balance. That means the more time you take to repay the loan, the bigger the loan balance grows. It's like a snowball rolling down a hill, getting bigger and bigger. And what if you don't repay the loan? Well, it won't send debt collectors knocking on your door, but it does have an impact. The death benefit, the money your insurance policy promises to your beneficiaries, gets reduced by the outstanding loan amount. So, while policy loans offer flexibility, they can also decrease your death benefit if not managed properly. Remember, it's not just about taking the loan, but also about managing it wisely. Withdrawals, on the other hand, are like taking a slice from your policy's pie. Now let's dive deeper into the mechanics of policy withdrawals. When you choose to withdraw from your policy, you're essentially reducing the death benefit. Think of it as a pie getting smaller with each slice you take. Now, unlike policy loans, these withdrawals do not accumulate interest, which can seem like a sweet deal. However, it's not all sweet. If the amount you withdraw goes beyond the total premiums you've paid, you might find yourself on the hook for taxes. It's like that surprise bill you weren't expecting. So, while it might seem like a quick way to get your hands on some money, policy withdrawals aren't without their own set of implications. You need to weigh the immediate access to funds against the potential tax implications and the reduced death benefit. Thus, while withdrawals can offer immediate funds, they come with their own set of considerations. Now that we understand how policy loans and withdrawals work, what are their pros and cons? Firstly, the advantages. Policy loans and withdrawals provide quick access to cash. This can be a lifesaver in emergency situations. Moreover, these transactions don't require credit checks, so your credit score won't be a stumbling block. Additionally, they offer flexibility. You can use the funds for any purpose, from paying medical bills to funding a business. On the flip side, there are certain drawbacks. Taking out a policy loan or making a withdrawal can potentially reduce the death benefit. This means your beneficiaries may receive less money. Also, there may be tax implications if your policy lapses with an outstanding loan balance. This could result in a hefty tax bill. The risk of policy lapse is another disadvantage. If you fail to repay the loan, your policy could lapse, leaving you without coverage. As we can see, policy loans and withdrawals can be beneficial, but they also come with risks. In conclusion, policy loans and withdrawals can be a valuable resource, but they must be used wisely. We've journeyed through the intricate landscapes of policy loans and withdrawals, highlighting their mechanics and weighing their pros and cons. Remember, policy loans can provide you with quick access to funds without having to go through credit checks or lengthy approval processes. On the other hand, policy withdrawals can be a way to pull out some cash from your policy without incurring any interest. But, like any financial decision, it's crucial to fully understand the terms and conditions of your policy. The fine print matters. Consulting with a financial advisor can also be invaluable in making these decisions. They can guide you through the complexities and help you make choices that align with your financial goals. So remember, your policy is more than just a safety net. It's a financial tool you can leverage. Please like and subscribe to this channel for more information like this.